I'm just going to introduce the next session. We have Professor Ricardo Suarez de Oliveira, who's going to moderate this session for us. So Ricardo Suarez de Oliveira is a professor of the International Politics of Africa at the Department of Politics and International Relations, University of Oxford. He is an official fellow of St. Peter's College and a fellow of the Global Public Policy Institute in Berlin. He is a co-editor of African Affairs, the Journal of Royal African Society, and the co-director of the Oxford Martin School Programme. Extensive fieldwork with a focus on the international political economy of African states, especially in regard to the extractive industries, the financial sector, conflict and post-conflict reconstruction, and African-Asian relations. He is the author of Magnificent and Beggar Land, Angola since Civil War 2015, and also the author of Oil and Politics in the Gulf Guinea 2007. He is also the co-editor of Co-China Returns to Africa with Chris Alden and Daniel Large 2008, and the New Protectorates, International Tutelage and the Making of Liberal States with James Mile 2011. He is currently writing a book titled Africa and the Offshore World. He has worked in the field of governance and extractive industries for organizations such as the World Bank, National Democratic Institute for International Affairs, and Oxfam. His individual and collaborative work has received support from the Leverhulme Trust, the ESRC, the Volkswagen Foundation, DFID, the British Academy, the Portuguese Foundation for Science and Technology, the Rockefeller Foundation, and the Kathaloosd Gulbenkian, I hope I pronounced this correctly, Foundation, amongst others. He has been a visiting professor at Sciences Po in Paris, a research fellow at the University of Cambridge, a public policy scholar at the Woodrow Wilson Center in Washington, D.C., and a visiting fellow at Yale University. Even I'm intimidated by this bio.
Thank you very much for that kind introduction. Let me just say a couple of words. I'm delighted to be here today. I'm delighted in particular to chair this panel, but I wanted to start by congratulating the organizers, the conveners of the event, because it's such a great event. There's been so many good perspectives. I missed the first panel, but it's been fascinating ever since, and I think it's a great opportunity to learn, especially on the interface between scholarship and the voices and experiences of practitioners. And my sense of this, as someone who's interested in this as a scholar, is that so much of this material is still emerging from experiences at the level of particular institutions, of particular regulators, of particular professional communities. So it's really a privilege to be here and to be able to address these matters in real time. So without further ado, I'll proceed to introduce this panel and also the speakers. Welcome everyone to session 4 on digital finance and economic crime. As the subtitle of the panel entails, it's a new era full of sometimes dizzying innovation, but the old vulnerabilities, technical, regulatory, etc., are here. They perhaps matter more than ever in the context of so many new arenas. We have fascinating papers that will look at matters verging from money laundering to derivatives, regulation to cryptocurrency. I'll pass on the word to our first speakers. I would just like to make a point. I'll introduce each speaker in turn as they proceed with their presentation. So now I will only introduce our first speaker, but I would like to ask all 3 speakers to keep as much as possible to the allotted time. I think what worked particularly well in session 3 was that the presentations were relatively concise, which allowed for 15 good minutes of interactions. Another point that I would also want to urge the audience to consider is that obviously there are many questions, but sometimes, especially on this panel, there may be matters of factual clarification that you would like to address to the speakers. So by all means, feel free to do so, and we'll convey those factual clarification questions to the speakers. So introducing the first speaker, Ms. Sangeeta Ghazi. Sangeeta Ghazi is a PhD candidate at the Faculty of Law at the University of Hong Kong. Before coming to HKU, she completed an international LLM at Duke University School of Law, where she mainly focused on the interdisciplinary courses converging on law, finance, and technology. Our speaker is interested on the impact of emerging technologies, blockchain in the payment system, the role of artificial intelligence and big data, and the role of fintech, and the way those technologies may amount to a game-changing impact in the financial sector. Therefore, her research interest involves issues that really are very interdisciplinary at the intersection of law, finance, and technology, which is very much the basis of her doctoral work, which focuses on the legal and regulatory framework of central bank digital currencies. So again, without further ado, I'll pass on the word to Ms. Sangeeta Ghazi.
Thank you so much for the introduction, and thanks to the organizers for inviting me to this inaugural conference. As we have seen, the proliferation of the decentralized finance and the integration of technology in the financial sector are giving birth to innovative and new financial products and new payment instruments, which is also redesigning the course of economic and financial crimes. And we have correctly titled the session, New Era, Old Vulnerabilities. However, with all these new changes and moderation, we often overlook the vulnerability of the emerging or developing economies. To give a brief example, I was working closely with the Bangladesh law enforcement officials when the cyber hit that the cyber hit of Central Bank of Bangladesh took place, in which incident the hackers stole some $81 million from the central banks. While there were like many reasons, the main reasons, underlying reasons, the fragility in the system or the use of like old-fashioned legacy system were to be blamed predominantly. Such vulnerabilities of emerging economies will not be cured overnight. So as we embrace decentralized finance and digital currencies, it will also need like relevant discussions, adoption of international framework, as well as like domestic regulation to enforce and combat economic and financial crimes. So it's great to see that as a session topic. So to begin with, if cryptocurrency is a money laundering vehicle or not, I would like to briefly define what money laundering is and what are the 3 stages of a typical money laundering scheme. So the definition of money laundering can be found like in different international regulation or international conventions. I would like to quote the Financial Crimes Enforcement Network of the United States, the way they define the concept of a crime of money laundering. They say that money laundering is basically disguising financial assets so they can be used without detection of the illegal activity that produced them. Through money laundering, the criminal transforms the monetary proceeds derived from the criminal activities into funds with an apparently legal source. This process has like devastating social and economic consequences, as money laundering is often used by criminals such as drug dealers, terrorists, or arms dealers, and other criminals to operate and expand their criminal enterprises. And developing countries can be particularly vulnerable to the crime of money laundering because it directly impacts the financial institutions, which are crucial for economic growth. It promotes crime and corruption within the institution. It reduces the efficiency of the real economy, decrease tax revenues, which can seriously jeopardize the growth of a country. So in order to prevent the widespread negative effects of money laundering and other financial crimes, there are some international framework in place, such as Financial Action Task Force has laid down some 40 plus recommendations, which almost all financial institutions, traditional banking institutions, are required to comply with across various jurisdictions. So moving on to the stages of a typical money laundering scheme, it has like 3 major steps. The first is called placement, which is collecting dirty money and placing them in a traditional financial system. The second stage is called layering, which is also known as structuring, and it is the most complicated process, which entails international movements of capital. During this stage, for example, the money launderers may begin to move funds electronically from one country to another country, place them in different financial institutions, or may start investing. Maybe may start investing in different schemes, and that's how they start eluding the detection. And during this process, they constantly move the funds from one place to another, and sometimes they take advantage of the discrepancies or lack of regulation or delays of judicial or police cooperation. The final stage is integration. It's basically the returning of the proceeds to the criminal or the perpetrator himself. So, and what appeared to come from a legitimate source, having been placed initially as cash or layered through a number of financial transactions, the criminal proceeds are now fully integrated into the financial system and can be used for any purpose. So why the concept of crypto laundering is relevant in the discourse of cryptocurrency? The money laundering. When we discuss about cryptocurrency markets such as Bitcoin, one thing we find pretty common, the scandals and the scams and frauds and cyber theft. Now, all this can be individual crimes and can be punished or enforced under the relevant laws and regulations. But the proceeds of this crime can be used for money laundering, and that's how it can actually undermine the integrity of the financial institutions. And for this term, I will use for cryptocurrency enabled money laundering, I will call it as crypto laundering. In a traditional money laundering, a criminal wants to hide the trace of illegality. In a similar vein, the primary goals of a criminal, of a cyber criminal who does steal cryptocurrency or accept it as payments for illicit goods, their intention also to hide the sources and convert that money into fiat currency without detection so that it can be integrated in the traditional financial system. To use cryptocurrency or Bitcoin for money laundering purpose, it's not new. As in 2015, the US Department of Justice seized some more than $1 billion in Bitcoin that was linked to the Silk Road website, an online black market that used to sell everything from drugs like stolen credit cards or sometimes murderers for hire. That basically leads to the question who are the parties that involved in crypto laundering. Of course, the perpetrator himself, and historically the mainstream cryptocurrency exchanges have been the primary destination of illicit cryptocurrency. For instance, the 2.8 billion that was moved from I mean, recently it was reported that in 2019, some 2.8 billion in Bitcoin was moved from criminal entities to exchanges, and almost like 50% of them. Sorry, is everyone hearing me?
Yes, we can hear you very well.
Yes, we can hear you.
I'm sorry, like I probably did
I
something.
can hear you.
Okay, great. Sorry, I probably like did something with my computer for some reason. Anyway, as I said, like in 2019, it was reported that some $2.8 billion were moved in Bitcoin, were moved from criminal entities to exchanges, and 50% of them went to Binance and Huobi, which are basically two prominent cryptocurrency exchanges. And recently, the cryptocurrency exchange BitMax was directed to pay 100 million so that they can settle with the claims of illegal trading and money laundering violations. Because it was alleged that they were involved in the transaction with darknet markets and some unregistered money service businesses. Another party that is involved in crypto laundering is third-party over-the-counter brokers and instant exchanges, which are largely unregulated. So this is the image I took from the Chainalysis Crypto Crime Report of 2021, which shows the destination of all cryptocurrency sent from like different illicit addresses. This is the monthly breakdown from like January 2017 to December of 2020, and that shows like exchanges, like different illicit entities, different unnamed services like peer-to-peer cryptocurrency network, and other risky services are basically the destination of crime process relating to cryptocurrency. The risky services here basically refer to those like exchanges that are operating in an unregulated space or in like high risk jurisdictions where there is no specific regulation of cryptocurrency, or maybe or regulation where or countries where the regulation basically permits cryptocurrency is legal. So criminals basically like take advantage of those jurisdictions and launder cryptocurrency, or like use cryptocurrency to launder money and convert them into fiat currency. This is another image showing these different crimes that these criminals do using cryptocurrency and the funds received by cryptocurrency exchanges or like risky exchanges. So these are like all the crimes that are related to cryptocurrency. So how is crypto laundering how is it different from a traditional money laundering scheme? While cryptocurrencies follow the same three-step laundering processes of placement, layering, and duration, the activity can be more difficult to trace due to the seemingly anonymous nature of cryptocurrency and decentralization. The traditional scheme also involves like smurfing or gambling. However, more advanced methods such as mixtures and tumblers or utilizing shady cryptocurrency exchanges are also used to disguise this flow of illicit funds. There are also like a rapid increase of different asset classes involving digital coins or digital currency, which can be termed like which has like different kind of names like initial coin offerings, Bitcoin futures, or which is a kind of a derivative product. Nowadays, we have this trend of like non-fungible tokens. And there's also another asset class which is very emerging, which is called semi-fungible tokens. So basically, all these like new asset classes are creating different avenues, different outlets for laundering money. It's not like it's not like evident as of now that there's no like a real-time data that they are using this, but if you can like track this, if you can see all these like assets pose different kind of threats and different kind of risk, which can be utilized or exploited by the criminals to launder money. So this brings to the next.
Sorry, we don't seem to be able to hear you now.
Can you hear me now?
Yes.
Sorry, like what was the last thing you heard me saying?
We just missed the last sentence or two.
Okay, so as I said, like this, the trend of this new digital asset class, they pose different kind of risk. They are being used as like outlets of crime, outlets of criminal, different kind of financial crimes and money laundering. And although there is no real-time data, however, because of the risk, we can potentially assume that this can be used for money laundering or other kinds of economic crimes. So this brings to the next slide, like the susceptibility of this cryptocurrency to laundering. We have all known that there's like some sort of like anonymity feature, which is not fully anonymous, but we call it like pseudo anonymity feature related to pseudo anonymity feature are like associated with cryptocurrency. And because of these like features of pseudo anonymity, there is a certain extent of difficulties to follow the usual procedures of follow the money. As we all know the concept we apply in money laundering. Also, the crime itself involves a sophisticated understanding of blockchain and or decentralized distributed ledger technology. So because of that, it's difficult for the law enforcement agencies to track the money from one digital wallet to another digital wallet. And due to this lack of expertise and skill of law enforcement agencies, especially in developing countries, the cryptocurrency as a whole pose a new kinds of threat to emerging economies. The currencies are always like being used across the dark web and it's difficult to trace. There is a lack of proper regulation, especially in addressing the regulation of the risky cryptocurrency exchanges. The use of like peer-to-peer crypto networks and sometimes crypto ATM to launder crypto ATM to launder cryptocurrencies and then convert them into fiat money makes it difficult to trace the fund. And because of the use of this DLT or blockchain technology, the transaction is basically borderless. It's fast, and there is often no intermediation of traditional financial institutions. So apparently there is no track of funds. And overall, there is a fragility in the security system, making it more vulnerable to cyber theft and scams and other sorts of like economic crimes. Speaking of the current anti-money laundering regulatory framework, as of 2015, when the first Silk Road scandal was revealed, there is no like specific regulation to address. They were like scattered, like sporadically people were addressing, regulators were addressing the issue, but there is no like an uniform framework. So the first time there are some domestic regulations, but internationally it was not until 2015, 16, or like maybe it has been finalized in 2019 when the Financial Action Task Force published its guidance for virtual assets and virtual asset service providers to bring them under a uniform international AML safety framework. Yeah, the European Union has like a framework. And similarly, there are like different domestic legislations like the United States, Canada, Japan. They are trying to bring the cryptocurrency exchanges under a regulatory, in a regulatory environment. However, the problem with the regulations are that they are very sporadic and sometimes it's opaque. There is a lack of clarity in defining cryptocurrency, and that's the regulators' approach towards cryptocurrency appears to be very fragmented. And sometimes like lawmakers are very cautious because they don't want to hinder the innovation, which is kind of like poses a kind of juxtaposition juxtaposition in the sense that this innovation also the emerging economies, especially developing economies, the way they perceive innovation is might be considered as threat, or might be considered as like something that is complicated and beyond understanding. So they try to put like an outright ban on the use of cryptocurrency, which is, whether it's right or wrong, that's a different question. But it's for the time being, it seems like reasonable, because at the same time, the regulators do not possess the skill of tracking the funds, or like tracking the outlet of this, like tracking this, how these cryptocurrency exchanges are being used for different kind of like crimes, economic crimes, or financing terrorism. So there's also like an ambiguity regarding the legality or legitimate use of cryptocurrency. So that's kind of like a different kind of like fragmented and sporadic approaches being taken in different jurisdictions regarding cryptocurrency, and to prevent economic crimes. In my view, there should be like an information and disclosure based centralized cryptocurrency jurisdiction. There should be a centralized system, means like all the exchanges that are dealing with virtual assets should be under a mandatory registration requirement. They should deploy these digital AML, digital ID, or like anti-money laundering or KYC protocols. And there should be like designated regulators to avoid this kind of fragmented and sporadic regulatory approach across the jurisdictions. There are like various ways we can combat this trend of financial crimes. But the question is like to what extent we can implement an uniform approach that is for the future. So this is from my part. Thank you.
Thank you very much. And I'm sure this will elicit quite a lot of questions further down the panel. I'm going to give the word to Dr. Ligia Catherine Arias Barrera, who's our next speaker. She's an associate professor at Externado de Colombia University. She's also chief legal counsel for financial services consulting, and also has a postgraduate degree from the Externado de Colombia University, as well as a doctorate in law from the University of Warwick. She specializes in financial derivatives and regulatory reforms in both the UK and the US. She's been a consultant on central clearing services, on the Nigeria-UK post-Brexit regulation, and is a registered independent expert at the IMF. She's also, in addition to lecturing at the Externado de Colombia University at the University of Warwick, she's the author of a book titled Regulation and Supervision of the OTC Derivatives Market, which was published in 2018, which was named one of the best banking law books by the Book Authority, as well as the co-author of the AI book published by Wiley in 2020. Again, I'll pass on the word to Dr. Ligia.
Thank you very much, Professor Ricardo Suarez, and all the members of the organizing committee for giving the opportunity to share with you some of the experiences that we have in Colombian derivatives market, and in general capital market here. The idea of today's presentation is just to give you some examples about how effective or not has been the regulation of conduct risk in financial derivatives in the context of Colombia. To start with the presentation, and just to provide a framework to see how regulators are approaching these sort of markets and practices in capital markets, we have to make reference to risk-based regulation, which is basically one of the favorites and most commonly used strategies for regulators, for financial regulators, in order to understand the dynamics of new risks and uncertainties that can be brought to the market from the perspective of different actors. So the idea here, and we could make reference to the works of Julia Black and so on, building the concept of risk-based regulation, is to seek common and homogeneous elements that help regulators to rationalize the regulatory processes. And for the purposes of financial regulation, we take advantage of this strategy because it helps us to understand that financial regulation could be divided basically into pillars. One of them, prudential regulation, and the other one, conduct of business regulation. So within that area and in the way we understand risk-based regulation, there have been some concepts that we could bring from the sociological studies to help regulators in their task to for identifying the most prominent risk that could affect what happens in capital markets. One of them is basically the definition of risk as an objective and quantifiable notion, which is basically the driver of this process of building up new regimes and new ways to understand how to better intervene a market, and also to decide whether it is necessary or not to do actually that intervention by means of regulation. However, there are some, and we actually are facing an example of that, some other future events that we cannot foresee, that cannot be measured and quantified as risk usually are, that we could try to locate within the area of knowable uncertainties, understanding that there's some certain practices and knowledge that comes from the actual functioning of the market that is not known, at least on time, by regulators, and that could be an important part of building up a new regulatory regime. Which, as you see in this slide, could help us to understand the better way to transform, to update, to reform, if that's necessary, a certain regulatory instrument, and to better manage those risks that are created in markets. In the process of designing this risk-based approach, there's a need to take into consideration different perceptions of risk. Ones are the risk perceived by regulators. Different perception could come from regulated firms, and also different approaches could come from individuals within firms. And we make reference in particular here to key individuals performing what we could call regulatory functions within financial firms. Those perceptions of risk should include the debate on the elements of what risk and uncertainties actually are, how to control these future events, how to better manage them, how to integrate those internal control systems that all financial institutions have with the regulatory objectives in a way of building an enforceable cooperation between self-regulatory instruments and the approach of regulatory agencies, state regulatory agencies. Also, to in this process, to understand the level of tolerance that we are going to have in front of certain particular events that we are aware are going to affect the functioning of the market, but we rely on the instruments that we have at hand to manage those sort of risk. And then, as a result of this dialogue and cooperation, build up the risk-based approach. Bringing all these concepts to the particular case of Colombian capital markets, what I want to show you is the few but good advances that we have in terms of regulated conduct by integrating a state regulation and self-regulatory instruments and tools. Colombian capital markets, the history, has been marked by reliance on directed and controlled self-regulation models. Despite the fact that we have from 2006 onwards, securities market self-regulator, which is well known in the region, and as the first way of materializing and giving the instruments to act to a private entity, helping regulators achieving some of the regulatory objectives. As you see in the second paragraph here, the first manifestation of self-regulation dates back to the 1960s, when what we have there was the Bogota Stock Exchange, and they were asked to conform a disciplinary chamber in order to monitor compliance with sector regulations for all those who participate in the market. Let's say not only intermediaries in capital markets, but all the participants. Then afterwards, with the Colombian Constitution 1991, the one that we already using now, the former National Securities Commission was given the rank, a more important rank in terms of the exercise of supervision, that we call superintendency, with intervention functions regarding what those disciplinary chambers of stock exchanges are calling to do, and to assume some functions related to help regulating the market, exercising a special type of supervision, disciplinary measures, and certifications of professionals in capital markets. Among all the functions that were given to the self-regulatory body for capital markets, we are particularly interested on the one related to the discipline and sanction of its members when there's any type of violation of securities regulation, but also any type of violation of self-regulatory rules. There are most of them related to the control of behavior of those market participants. And I want to make an emphasis here, because we are going to see later on an example of a recent scandal in capital markets of one of the intermediaries that are actually, or were better, under the disciplinary sanction of this self-regulatory body of capital markets. One of the great advances on the self-regulatory body is the disciplinary court. The disciplinary court decisions that we see now operating in the market attend to an specialized knowledge and interpretation of the criteria that we have to use to judge conduct of a stock market, but also OTC market participants. The idea is that compared to what happens in the jurisdiction, what we call ordinary jurisdiction by civil and criminal law proceedings, here in this disciplinary court, the cases are approached with a very judicious study of what actually all these duties that are required of financial intermediaries it would imply that they talk about and have developed fiduciary duties, loyalty to the investor's interest, how to better provide advisory services for all those who participate in the market. Of course, when the self-regulatory bodies start to function in Colombia, there were questions around if they're meant to replace the supervision that is conducted by the financial superintendency in Colombia, and in order to clarify that the question, that we have a ruling of the Constitutional Court with that reference of 2010 that clarified that the existence of that self-regulatory mechanism in the Colombian capital markets didn't entail a delegation or a duplication of the functions of control of capital markets that were assigned to a specific entity, the superintendency, the financial superintendency in Colombia. Among the disciplinary sanctions that are regulated by regulatory agencies and then implemented by the self-regulatory body, we have different forms of expulsion from market, suspension, limitations of activities for a short period of time, functions and operations, fines, censors, reprimands, and others that disciplinary court could judge as appropriate and that do not enter in conflict with the other sources of liability here. There will be administrative liability among the process of coming from the process led by the financial superintendency, and of course criminal justice. Regarding conduct regulation mechanisms adopted by financial superintendency in Colombia, we have a document, circular of 2006, established a procedure to evaluate those conditions that directors and legal representatives, and now we see that extended to all those related with internal control systems and compliance officers. In terms of the requirements that they are expected to meet to perform certain functions, it's our own way of trying to bring to a regulation the standard of fitness and propriety that has been already put in place in other jurisdictions. Despite the scant attention that has been given to mechanisms to control behavior, to control conduct of business within capital markets. During last year and the beginning of 2021, the Financial Superintendency issued a guidance in terms of, and seeking, of course, the process of dialogue with market participants in academia and all those who might be interested in giving their opinions. In order to give more content to that fitness and propriety standard, by making more individuals within financial institutions liable under that regime. Despite the important progress that we are actually in the process of completing, I think during this year, several concerns are still there when we read the guidance. Basically, we make reference to those related to the enforcement mechanisms that will be used in the event, for example, a director breaches a rule of conduct that comes from self-regulatory instruments. It is not clear whether the financial superintendency is going to expand somehow their mandate, its mandate, to cover and to be able to sanction any sort of these violations, and how that regime would actually function. We bring this idea of how Colombian regulators have decided to approach conduct of risk, because one of the markets within the world of capital markets, one of the sub-markets that probably creates some concerns and a lot of questions around certain practices that could be judged as dangerous or risky are financial derivatives. Financial derivatives, just to give you the very basic notions around this market, are securities in most jurisdictions. Colombia is one of them. Financial contracts whose value is derived or comes from the performance of an underlying asset. So basically, at the beginning of our financial contract, we do not know exactly the value and the price of our contract. We only will find out this price depending on what happens from now to the future event with that underlying asset. And there are many different types of underlying assets, as you can see it here. Another concept that is common to all these financial derivatives is the idea of notional and principal amount, which is the reference value that we will use to calculate the obligations of both counterparties. Among the functions of financial derivatives that we could identify in a market that actually has different contracts that had no similarities among them, different from the ones that come from the notion and this the concept and the notional amount. And that's why it's difficult to try to regulate in just one specific way all financial derivatives contracts. But we could agree that the functions that usually financial derivatives are expected to do are referring to hedging. Mainly is hedging is the most legitimate functions of financial derivatives, help us to protect our company, our enterprise from volatility from the default of our counterparties. They also serve this function of financing mechanisms. And one of that I want you to focus in particular is one function that is a challenge for all regulators anywhere in the world, which is a speculation. And a speculation is not per se considered illegal, but regulators tend to be really concerned when they identify institutions that tend to enter in transactions that have purely a speculative a function or intention. Then we have, in general terms, that a speculation or that practice show us that there's no real interest in protecting ourselves from certain risk, but instead we want to study the market, foresee in advance, know or anticipate market movements, and then being able to obtain profits from those movements. This practice that is well known in financial derivatives extends in other parts of capital markets. And that was particularly the case of Interbolsa. Interbolsa was an intermediary of the market, on the stock market, and they defaulted, as you see here. Interbolsa defaulted in an intraday payment of 20,000 million Colombian pesos to an obligation, a line of credit they had with BBVA Bank. As a reaction, in this fear of liquidity crisis in the market, the financial superintendency issued a resolution, basically take the mission of taking immediate possession of the assets, business, and all the other ways of participating in the market that Interbolsa had by that time. It was the end of the second semester of 2012. There was what was the core problem with Interbolsa strategy and why they end up defaulting their obligations. There was an intention of Interbolsa to buy a company called Fabricato, a textile company that had been left out of one of the largest conglomerates in Colombia called Antioqueño Union, which made things a bit easier for Interbolsa, because as the company didn't it wasn't part of the conglomerate anymore, they had to buy some shares directly from retailers. The business idea was very basic: buying Fabricato at a very low price and then selling the company for its real value, and taken advantage of that, of course. Interbolsa could have used, as in normal circumstances, use an IPO in order to access and to buy these shares from Fabricato, but they didn't do that. What they do was to use another well-known operation in capital markets, which is called repo operations. And here we could, in very simple terms, Fola, do you need to ask something?
Yes, sorry. I just wanted to ask if you could wrap up in the next minute or two, just because
yes,
we're not doing
I'm just about to finish.
Okay, thank you so much. Thank you. I didn't want to interrupt. Thank you.
No, sir. So what they used was repo transactions, and here you have the short explanation for that. Someone who has shares needs a cash but does not want to sell their shares. He goes to a broker, in this case Interbolsa, who finds him a counterpart who makes the loan on the shares. The shares remain as collateral, which of course he recovers when he cancels the loan made into the shares. One of the most, let's say, sadly famous investors here was called Alessandro Corridori, who actually used exactly this strategy. And the problem, if you see, the problem is not the use of repo, because repo transactions, repo operations are well known in the market, even if they don't have a particular regulation. But the problem was that the speculative terms in which these transactions were actually done and how they end up affecting a large part of those investors that have entered into certain agreements with Interbolsa to, of course, be benefited from these sort of investment strategies. So just to finish here, what I want to focus your attention on is that we already have some conduct of business rules, regulation that is in place, that has been agreed between market participants and regulatory agencies. But despite that seems not to be enough and sufficient to control certain practices of the market, in this case in particular, purely speculative transactions. So that's the current state of affairs here in Colombia, and I would be happy to answer your questions when we reach that point. Thank you very much.
Thank you very much. Thank you very much. And I'll proceed to introduce our last speaker, Ms. Mercy Buku. Mercy Buku is a certified anti-money laundering specialist and an advocate at the High Court of Kenya, commissioner for oaths and notary public, and was admitted to the Kenyan bar in December 1989. Mercy is currently practicing as an anti-money laundering SFT legal consultant in the mobile payments and banking sector, and was previously the senior manager, money laundering reporting office in Safaricom Limited in Kenya, where she was charged with the responsibility for overseeing the anti-money laundering function for Mapesa, which must have been a very interesting role. And Mercy has a very extensive, very distinguished CV with international organizations such as the World Bank, the Financial Services Volunteer Corps, GIZ, etc., etc. She was also privileged to be invited to address the UN Security Council in 2019 on the topic of financial inclusion and financial integrity. In the interest of time, I won't read out this lengthy and distinguished CV, but rather pass on the word to Mercy so that she can do her presentation.
Thank you very much, Ricardo, and good afternoon, good morning, everyone. It's a privilege for me to be part of this gathering. And without further ado, I'll go straight on. In fact, I was talking to the coordinators earlier, and I was mentioning that every topic today actually deserves a half day or a full day workshop. These are very weighty topics which cannot be really covered in 10 minutes. And that is why we are all very breathless, just trying to get through it. So we are going to be covering risk-based approach to addressing money laundering and terrorist financing risks. These are the topics I'll cover very quickly. Digital financial services and financial inclusion. You can't talk about risk-based approach and digital financial services without talking about financial inclusion. We'll look very quickly at the vulnerabilities of DFS to risk, the typologies and trends, and then we'll now zero in on the risk-based approach, and then look at the role of providers, supervisors, and regulatory agencies. So there are 4 categories of digital financial services. We have payments, asset management, alternative finance, and also others which are based, for example, on, insurance services, etc. And as I put up the screen, I'll just highlight key points. I won't go through each and every word that's on the slide. So when we talk about digital financial services and financial inclusion, these have actually been at the center of financial inclusion initiatives in many countries, especially in sub-Saharan Africa and Southern Asia. Why? Mainly because there was a lack of access to traditional financial services in these regions. Again, increasingly widespread use of mobile phones. Mobile financial services are included under the definition of DFS. Mobile phone-based economies where these mobile platforms are being used as alternative channels. And especially with regard to MFS, these are foundational to DFS inclusion. Why? Because they are cheap and reliable. They've also been supported or backed up by favorable regulatory environments and supervisory good practices. Again, they have become a key driver of socioeconomic growth. And more importantly, right now in this COVID era, they are the primary channel for increased cashless transactions during this time, especially because of the movement restrictions and even regulatory incentives promoting cashless transactions. So that's the digital financial services ecosystem. You can see there, this mainly is on mobile money. Just on one phone, you can do all those, you can get involved in all those other financial activities just on the basis of the phone. So what are the risks? And why are digital financial services, which are also known as new payment products and services, why are they vulnerable to risk? And why have they become so attractive to fraudsters for the perpetration of fraud and other crimes? We talk about the wide prevalence of mobile phones. I've mentioned that. Lack of fully automated fraud prevention transaction monitoring systems, for example, for the providers. Ease of delivery, and this is a cashless, the cashless functionality, non-face-to-face. Again, there have been so many new products being offered on digital payment platforms. And especially now during the COVID era, we are finding that these vulnerabilities have actually increased because of the incentives encouraging increased cashless payments. So what I have said in that previous slide is that actually those attractive features actually promote fraud or create opportunities for fraud and other criminal activities. So what is the money laundering link to DFS? Illegal proceeds from predicate offenses can be laundered through mobile money and other DFS platforms. For example, through P2P transfers for the small amounts, the corruption, for example, the policemen on the roadside who are given small amounts of money, you send the little money to their M-Pesa or their mobile money, or they're given small denominations in cash and they'll go and put it in their wallet. And it goes through the same money laundering cycle as Sanjit had mentioned in her presentation. Cross-border wire transfer channels can also be used as conduits. And then when we look at the predicate offenses in Africa, corruption tops the list, fraud, there's drug trafficking, illegal wildlife trafficking, all those terrorist financing, of course, is very real to us, especially in my own country, human trafficking, etc. So what are the key risk categories? because we need to understand what the risk factors are so that we can also understand how these risks can be mitigated and regulated also against. So we have product and service risk. The explanations are there in terms of the speed and the portability and anonymity. Operational and reputational risks, for example, liquidity challenges, failed systems. Geographic risk, we are looking at porous borders and poor risk management controls, for example, low levels of AML reform, for example. Then MLTF risks, especially countries with unbanked populations, poor KYC measures, etc. Consumer risk, issues around transparency and lack of industry standards. Agent risks for providers who have hundreds and thousands of agents. Compliance becomes an issue. System and delivery risk, inadequate systemic controls, lack of the transaction monitoring systems. And then again, and the list is not exhaustive, we have regulatory and compliance risk. If we don't have appropriate regulatory regimes which govern financial services, we don't have AML legislation in place, and then that becomes a loophole. And then again, also these risks also hinder the rendering of financial services to the financially excluded. So if you look at the typologies, there are many of them, and these are more diverse, may not be as easy to detect as traditional banking frauds. They mainly comprise online fraud. We are looking at phishing. We are looking at farming, spyware, mobile money and mobile banking frauds. You'll be getting this presentation so you can just read for yourselves in detail. Data privacy is there. One of the previous speakers mentioned this. Profiling, and also hacking. And in fact, hacking is one of the, and even the mobile money and mobile banking frauds are one of the primary typologies. So we also have, because of the proliferation of the new products being offered on digital financial services platforms where, the providers, the MNOs are signing, they are entering into partnerships with other financial service providers to offer services on their platforms. We have emerging risks, which are more or less similar to the existing risks, but now they have come up around the new products. So digital savings, the digital insurance products, money remittance, all these services are being offered now on mobile money and other digital platforms. Debit cards, you can actually use your phone as a debit card. Prepaid cards, securities and investments, which can be paid for through mobile money or through the proceeds of crime. Again, digital currency is also being offered on digital payment platforms, including mobile money platforms. And I'm focusing a lot on mobile money because this is what we know. This is our primary digital financial service channel here in Africa and even in Southern Eastern Asia. And then also we have mobile network risks. When we talk about mobile network risks, we are talking about the line that you have, not the mobile wallet. The line that you have, criminals use the networks to organize their criminal activity. So how do we mitigate these risks? We have our international controls, and Sanjit also mentioned these international and AML banking protocols, the FATF and Basel recommendations and guidance notes on KYC, training, suspicious activity reporting, transaction monitoring, etc. We have the regional FATF guidelines. For example, in my part of the world, we have the ISAMLAG. In Western Africa, we have GIABA. Is it GIABA or GIABA? We have MENAFATI for the Middle East. And then we also have the UN conventions, which criminalize the various predicate offenses. And then each country is expected to enact legislation which complies with those international protocols. So the AML legislation, the prevention of terrorism, poaching, anti-drug trafficking, consumer protection, data privacy, etc. And also sector-specific regulations. So for the banking sector, for the telco sector, insurance sector. Then we have the Reserve Bank or Central Bank supervisory, prudential and regulatory guidelines. Either they can be the Reserve Bank or the insurance regulator, the capitals market. They have also issued their own guidelines. And then internal provider controls. These regulations then require the providers themselves to have in place anti-money laundering compliance programs, which enable them to comply with the legislative provisions, and they will be applicable to all digital financial service providers. And then, of course, the last prong in that is the law enforcement, investigation, prosecution, and sanctions. So now we can zero in on what is a risk-based approach. What does it entail? So the importance of risk management in DFS is because of the escalation of DFS fraud and other financial crimes. So there's a need to implement comprehensive risk management programs. But what we are saying here is that innovation must go hand in hand with appropriate controls. I remember when I was working for Safaricom, I used to be known as Madam KYC, and we had a love-hate relationship with our business department because they wanted their products rolled out yesterday. And I would tell them, no, we have to do a risk assessment and actually ascertain what the risks are and how to mitigate them. So we need to balance business expediency with controls. And so we are saying, however, even as we mitigate these risks, we should not stifle financial inclusion. So for us in risk, and this presentation is from a provider's perspective, not academic as such, from a provider perspective. So for me to mitigate those risks, I had to bear in mind that the business must also be allowed to roll out and reach those unbanked and roll out their products as well. So inappropriate regulation can actually unnecessarily exclude customers and grow the cash economy instead of the reverse. It will make transactions harder to track, hinder consumer protection efforts, of course, when we have the cash economy. Combating financial crimes also will be difficult. Again, then financial inclusion will increase. So balancing AML, CFT, and inclusion policy objectives is very, very important. So the key aspects of the risk-based approach, this must be informed by a national risk assessment. So entities are required to take steps to identify and assess their risks and appropriate to the nature and size of their business and have policies in place to mitigate those risks. And 2 exemptions are allowed where there's a proven low risk for a particular institution or activity, or where there is very occasional or limited financial activity, de minimis. Other than money value transfer where full then KYC is required. So regulators may allow simplified CDD where the risk is lower, or enhanced CDD where the risks are higher. So when we talk about risk-based KYC, we are saying this is the obligatory approach that should be taken by regulated businesses or providers to target their resources for anti-money laundering in a proportionate manner. And the FATF recommendations actually allow this. And this can also include carrying out risk profiling of your customers to categorize them as high, low, and medium for purposes of the documentation required. And on the right there, I've given examples of successful implementation of risk-based KYC. Mobile money is one primary example, and then the specific DFS products which have come up around mobile money, digital credit and savings products, etc., where the KYC is pegged to transaction limits and volumes as well. And even in Mexico, we also have simplified due diligence examples for account opening. And so FATF have actually come up with a specific guideline on the risk-based approach for digital financial services under the new payments or NPPS guideline of June 2013, which provides for regulated businesses to apply risk-based KYC for low-risk customers or enhanced KYC for high-risk customers in specific situations. For example, in non-face-to-face transactions, entities should obtain and verify evidence in a more rigorous manner than they would for face-to-face transactions. So what are the issues to consider? So standard identification requirements may not be readily available. As I have said, the FATF recommendations do offer flexibility to ensure certain groups are not unreasonably excluded from accessing financial services. So for example, where customers are in rural or remote areas and they cannot produce a standard evidence of identification, for example, like birth certificates, you require a birth certificate to get your ID, to get your passport. Financial institutions are actually allowed to determine alternative appropriate measures to deal with these situations. These can include, for example, accepting other types of identity, such as a letter from a chief or an appropriate person of standing, appropriate photo ID cards, for example, the employment card, driver's license, refugee cards, supporting letters also from community leaders in refugee camps. I've had the privilege of making a presentation in sessions on financial literacy and financial inclusion for the forcibly displaced. And these are people who are also financially excluded and also need to be brought on board. So regulators also need to consider the vulnerable groups, the youth, elderly, women, especially when they are looking at issues around a risk-based approach to supervision of financial service providers. So as I finish, what is the role of the supervisors? And I'll just go very quickly here. So risk-based supervision requires legal and regulatory flexibility. It requires regulators with the right mindset, with the right capacity, expertise, and experience. They also need to be financially literate. They need to know their products. They need to know their customers, who are the financial service providers. So it should not be a situation where the provider is coming to dictate to you what they want. No, the regulator also needs to know about the products and educate themselves accordingly in order to be able to regulate them. So coping with the challenges of this fast-changing landscape is not easy. These are just recommendations. Prudential supervision, look at your AML, CFT, your consumer protection measures, payment system safety and efficiency, competition and innovation. All these are factors that need to be looked at when you are thinking about risk-based supervision. Financial inclusion, balancing it, financial education, and then this must also be tied to effective data collection mechanisms, quality over quantity data that will help supervisors. And then again, leveraging on technology and innovation to support the changing mindset.
Mercy, I have to ask you to wrap up because I think—
Yes, actually, I'm on my last slide. Yeah, so this is an issue of balancing business objectives, balancing the risks and benefits of regulation and supervision, balancing the risks and benefits of digital financial inclusion. How do you accommodate the different sectors and a whole range of providers and products, and optimizing the use of regulatory and supervisory resources and powers? So as I conclude with these two statements from the No Money for Terror Paris Agenda of 26th April 2018. Innovative financial technologies and products and services may offer significant economic opportunities, but also present a risk of being misused by criminals for money laundering and other criminal activity, including terrorist financing. And then this paragraph from my briefing, which was mentioned in my bio. It is therefore of critical importance that governments in these jurisdictions put in place enabling AML, CFT, and financial regulation, which will not only comply with the FATF standards and applicable UN convention, but will also facilitate financial inclusion initiatives while ensuring the integrity of the systems used to deliver these services so that they are not used for money laundering and terrorist financing. And with those few remarks, I say thank you very much. And I've got some references there that you can look at when you get the presentation. Thank you.
Thank you very much, Mercy. And at this stage, for an excellent presentation. And all three presentations, I think, confirmed your point that each would deserve a panel in its own right. So we're unfortunately very, very lacking for time for a proper discussion with the audience. I would like to ask the co-organizers if, as far as I can see, there are two questions here, both to Mercy. Would it be fine to ask these two questions and ask Mercy to be extremely concise in answering them before wrapping up the panel, or would you rather move on to the next panel?
I think we can take the two questions for Mercy, and also there's one question I've seen for Catherine, but if, again, like you said, if we could make them very concise so that we can move to the next panel. Thank you.
Thank you. I can see actually two questions for Catherine. So I'm going to read out the two questions for Catherine and for Mercy. And I would ask both to be exceptionally concise, 45-second replies, if possible. To Catherine, the questions are the following. The first is, would recognizing interconnected risk positions enable an organization to assume more risk due to portfolio diversification effects? And the second question is, what should be the conduct of an organization where only few people within the organization truly understand the nature of its derivative activities, which I suspect is the case more often than we'd like to admit.
Yes,
so Catherine, your questions very concise.
The first one.
And I'll just read out questions for Mercy, and then I'll pass on the word to both of you. Mercy, I think you can see the questions yourself anyway in the chat tab, but the first question is, what is your view on the phenomenon of de-risking by financial institutions and its implications on financial inclusion? That's a very sprawling question, so you might just want to touch it briefly. And the second one is, what prospects for insurance in covering the losses of bankers and financial service providers in contexts where consumers are losing huge sums from fraud, and many of these are in collusion with insiders. So these are the questions. Catherine first, as I said, as briefly as possible.
Okay, thank you, Ricardo. Yeah, indeed, one of the practices that is commonly known in financial derivatives is trying to create structured products in order to take advantage of this portfolio diversification. So I think one of the tools that regulators might use to make a great intervention in this area, and to avoid probably the problems coming from asymmetry of information, is related to more accountability of those who are in charge of designing this sort of products within financial institutions. So this is to link with the second question, how to better manage the conduct in organizations when only few people knew actually what they're doing. One tool that is already being implemented here in Colombia is to strengthen compliance officers' liability, and to make them, let's say, a hands-on for the supervisory authority within the context of the financial institution. That would help us to better understand what derivatives are being used, how these products work, and then impose our liability regime that actually works.
Okay, that was under 2 minutes. Thank you very much. Mercy, if you can do as well as Catherine in this regard, please.
Okay, thank you. In terms of insurance, actually, we should try very much not to get to the place where we need to call on insurance. But yes, regulators have put in place deposit insurance schemes. But I think prevention is more important. Put in place the relevant regulations, ensure that providers have the necessary controls in place to mitigate against loss. And consumer protection is key, complaints, recourse, etc. These are very good fraud prevention measures. For de-risking, what I would say is that FATF actually does not advocate for wholesale de-risking. It's more an issue of how you assess your risk. And if it is if you feel you've reached a position where you need extra EDD to carry out EDD on a particular client, then you need to approach them and actually request for the further reassurance in terms of the documentation. If indeed then you are not confident or you don't get the response that you expect, then you can exit that relationship. But as I said, FATF prefer a risk-based approach to wholesale de-risking. Thank you.
Okay, thank you. That was even briefer and very sharp. Thank you very much. I have a very, very brief question to Sangeeta, just to wrap up the panel. The picture you presented was very consistent. You know, cryptocurrency use as for money laundering is, as you said, borderless. It's fast. There's no intermediation. There's no track. My question is, are there any reasons why money launderers wouldn't just escalate the use of cryptocurrency endlessly? Because what you said seems to be an absolutely unrestrained growth dynamic. Are there any reasons why money launderers might hesitate in their use of cryptocurrency for money laundering purposes?
Thanks for the question. So it doesn't have any easy answer, to be honest. But what I'm trying to present here is like the cryptocurrency is gaining popularity not because of its like these negative features. For example, like the vulnerability of the system is not the reason why cryptocurrency is gaining popularity among users. It also has some sort of like positive effect.
Of course, that was implicit.
Yeah. The problem is that the vulnerabilities of the systems are being exploited by a particular group of people. So, and my take towards this situation is like the regulation is not basically like coping up with the innovation. So this every time these new digital asset classes are like emerging, new vulnerabilities are also like emerging, which are kind of like the regulators are probably trying to like keep up, but it's somehow like they're missing the point. So it's not unrestrained, but the question is like whether an effective regulatory approach is going to be taken or not. As of now, the regulatory approach are like sporadic and fragmented, and there is no international cooperation as like emerging economies and developed economies are perceiving this problem from a different angle. So it's not unrestrained. They would be hesitant if an effective regulation is actually in place.
Thank you. That was very clear. And this is all. This is the end for me. I'd like to thank once again the panelists for 3 excellent, very thought-provoking presentations. And I'm going to pass on the responsibility for the next panel to the co-organizers. Thanks for having me.
Thank you so much. Thank you, Ricardo. Thank you to all of our speakers for a really insightful session.